Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
Welcome back, ladies and gentlemen, to the Family Banking Show. We are your hosts, Derek, Rob, and John. Guys, how's it going this week?
Good morning. Hello from Franklin, Tennessee.
And hello from San Antonio, Texas. I know it's
And
probably like 10 degrees in Minnesota right now, Derek, but I'm outside. It's beautiful out here. So,
I'm glad
What
you
what is
guys.
the temp?
let's see. It's 62 right now. Not too
37
bad.
here.
Yeah, it's probably about 20 outside right now. So, yeah, we're recording this right before Christmas. So, we want to say to our listeners a very Merry Christmas to you and
Merry
hope that
Christmas.
you are able to spend time with friends and family and the people that you care about most. As we reflect and spend time each other and individually on why we celebrate Christmas, it's always helpful to remember that this is the time that we get to celebrate the birth of our Savior and Lord Jesus Christ.
Hmm.
And guys, I hope that you have a Merry Christmas, and it sounds like you're going to at least be somewhat warmer than me, which is not always a bad thing. I'm very jealous of you.
I'm heading back actually very shortly. So
Okay.
we'll be nice and cold. And I think this will be my first ever white Christmas.
Ah,
Uh, with snow on the
Oh,
ground.
fun.
So I feel like a little kid. I'm gonna build a snowman for the first time
Yeah.
and do all that stuff with my kids. But yeah, no, I have a funny story actually. We tell my daughter, she's 3, that what Christmas is about. It's about the birth of baby Jesus, and that's
Hmm.
just an amazing gift to us. And we talk about it through different books and stories, and then she saw presents under the tree here at my parents' house, and she goes, "Are one of those gifts baby Jesus?" Like, still hasn't really quite grasped it. So, but yeah, I mean, we love talking about the meaning of it and not just gifts and trying to show how much you can give or anything like that, but really acknowledging just how amazing it is that Jesus was a human and that
Yeah.
he came to earth. So yeah, it's pretty special.
John, did you roll right into that and say, yes, baby Jesus is a gift, the gift
I
of
did,
salvation
yes,
through him.
I
Yeah,
did,
that's great.
just not in a box.
yeah,
Mhm.
exactly.
Yeah. I gotta give a shout out. You can tell I'm in my nephew's hi- his podcast studio. I don't know if you know caught that, but that's the Amazon
Oh yeah.
Ads podcast. So his company, they manage companies' ability to place product on Amazon in a way that it's like I don't know, it's a market, it's not really marketing, but it's a ad placement kind of software and processes. So that's why I have the lighting, I've got the setup.
Yeah,
Well,
looking sharp.
Very. All right, guys. Well, in this episode, we're going to be talking about something that's very common to our listeners. Is this idea of what if I can't pay my premium? What do I do next? And it resonates with all of us, having the unknowns of life and the uncertainty of, if you were to lose your job or something were to happen, how do you pay for this premium? And it's like I said, it's something that's very intimate, very personal, and something that we get asked quite a bit. So, in this episode, we're going to discuss what those options might be for somebody if they were in a tough spot like that. But John, why don't you talk about the mortgage example that you had mentioned previously? How do we think about using life insurance as an asset or viewing it as an asset? And maybe how is it similar to the mortgage?
Yeah, absolutely. So we all, I think, can relate to just owning a home and particularly what that home means to our families. For the most part, we work with families, and the home is a really, really valuable part of their lives, right? If you missed a mortgage payment on that home, that would have a huge effect on your kids, um, on your lifestyle, on everything that's involved with kind of the ins and outs of your daily routine. So you're probably motivated to keep the mortgage payments paid, right? And knowing that not only are you um, keeping a lifestyle for your family, you're building an asset for your family, you're building equity for your family. So you feel very incentivized to make those payments, right? Even though it is, technically you're on the hook for it every month, the bank can come knocking on your door. It's like there's lots of, weight to having a mortgage payment. Uh, it's a good thing to make your mortgage payment, right? And it's a good thing for your family. You're providing for your family. So in the same way, that's all the more how I view premiums into my asset that happens to be a life insurance policy that I know is protecting my family far more than a house can,
Right.
that is building generationally far more than a house can. Although housing, can be a form of generational wealth that you can pass on. So that each premium payment, not only is it um, building this asset, but it's also going to be something that I can see pretty immediately. If not like that day, maybe within a couple weeks, and definitely every dollar that I put into it, I get that and many more in the form of cash value. So I know that like I'm not losing out on any of these premium payments. We like to call them premium deposits into our family bank. And as we make those deposits, they grow and grow, and we have access to it. Unlike in the home example, you have to, again, go hat in hand, get a HELOC from the bank to then finance the equity. So, um, similar, but all the better to have your premiums as something that you're truly building, like for 4, 5, 6 generations that you can cast the vision for just to plan and make these premium deposits into your family bank. So it's very much a good thing to be on the hook, for these premiums.
Well, I'll add to that too in terms of okay, the first how you started the conversation, Derek. The when I first got my whole life, my infinite banking style policy, there was, it's some trepidation, just like everybody, because it's a contract, it's a unilateral contract. As long as I pay my required premium, the insurance company is contractually obligated to fulfill all the obligations of the contract. But it's a contract, right? So I'm like, wow, I have this thing I have to pay, and I do it annually. Um, I think that's the most efficient way to do it. So I do it annually. But it was a little nerve-wracking. But one of the things that gave me some peace was that the way we design it, well, we talked about this in previous episodes. We have the base portion of the contract, and then we have the paid up additions rider portion. So your total annual premium will be a combination of base plus paid up additions rider. The only component of that is the required by the insurance company to be paid is that base portion. And that's typically significantly smaller than the paid up additions portion. So I looked at it like, okay, well, I can, and then this might be a way, we talk to clients about this, but I tend to talk to it like this. The base is something that I don't sweat over at all. I can pay the base without even thinking about it. I can keep my contract in good standing without any issues. The paid up additions is one that might be something I have to go through the rest of the year to kind of gather up and then pay that off. And so once I kind of got my head around that the base is my minimum requirement, that just kind of freed up and took that tension away. Like, oh, the base is actually very manageable. Paid up additions is like what I really did want to do because that really accelerates the policy. It accelerates that cash value. And so that really helps. That helped me out in one aspect of being comfortable with it. And then now every year I just look forward to it. I can't wait to pay my premium. I can't wait to pay my paid up additions. We just added another policy, on my wife, and I can't wait. That's paid, and I can't wait till next year to pay it because you see, if you have that long-term vision and you see this policy over time, it's exciting to see the growth, the value, the death benefit, and how that will bless your family now and bless your family in the future. So it really becomes something you look forward to doing once you really get your head around, the idea of it.
Yeah, and as we were discussing before we hit record, a lot of this has to deal with mindset. And as Rob, as you have mentioned, and I think for those of our clients that have a policy or have been doing this for a number of years and maybe a series of policies, it's always that bit of trepidation just with the first policy. And then as you get more comfortable with it, you get to that point like you're talking about, Rob, where you're excited to pay your premium, you're excited to fund your paid up additions rider. And I have clients and relatives that are itching to figure out, can I put in more? It's not
Hmm.
not a question of how little can I pay. It's how much more can I fit into this contract in order to maximize it to its potential. And that's certainly something that we would encourage our listeners to be thinking about. Guys, as we get into some of these reasons or solutions to this problem of what if I can't pay premium, one great change, just a simple change, would be how frequently your premium is being paid, essentially. Rob, you had mentioned about paying a policy annually. And for some people, they can do that. For others, it might be semi-annually or quarterly or even monthly. We can't go shorter than monthly, but that would be an easy switch of if you were paying annually, one solution might be, well, what if I can just pay this month's required premium and switch to monthly frequency rather than an annual payment in order to give yourself enough time to get back on your feet, whatever it might be, to get that additional cash flow to keep paying premium in the future. What do you guys think of that solution? Is that something that you would suggest to our clients?
Yeah, let's say your premium's coming up. And it's also let our clients know that there is a 30-day grace period. So if your payment is due on January 1st, you have 30 days from after January 1st to pay your premium. But let's say you were on an annual mode and your due date was coming up on January 1st and you just didn't have the amount of free cash to pay for that annual lump sum for that year, you can break it up into like monthly or bi-monthly or quarterly, so you have that flexibility. That's the thing, just maybe at the front end, I'm just going to say our clients, until we educate them, they don't realize, and I'd say the public in general, they just don't realize how flexible these policies are. They think they're these very rigid contracts, but there's flexibility built into the contract. It just gives you that peace of mind that insurance companies they want you to keep paying. So they provide all these options to enable you to manage life through changing the modality of your payments is one of them. And I think that's just something to keep in mind. If for some reason if you're doing annually and you just I don't think I can swing it, you can change that to monthly or quarterly or biannually. So there's a lot of flexibility there.
Mhm.
I think a very important consideration also is just even backing up like how much the premium ends up actually being in relation to your household income. Like having a great conversation about that will alleviate many fears when it comes to
Hmm.
follow-on conversations about what if I can't afford it. So that's part of our process. That's part of understanding what is that manageable and meaningful premium, because $10 a year is not probably going to do much as a family bank, but
Right.
maybe $100,000 is going to be unmanageable, stressful, and just outright crazy if depending on what your household income is. So, we don't want to recommend anything that is going to add stress to your life, right? And
Right.
one thing that I firmly believe in life is that people want to buy more of what they want, not of what they need, right? If it's like car insurance, you want as little as possible, right? Because you need it, I guess, and I guess it's a law, and you have to have it, and all sorts of things. But if you want like a new, whatever it is, even like a home for your family, if you're renting or something, like you're gonna work hard probably to achieve that, and other things that provide the lifestyle that you want. So anyway, all to say, like this is something that we love talking about before even getting to the point of what if I can't afford it is what that number should be. Um, and getting real clear on what that looks like so that These conversations of what if I can't afford it are few and far between, really, particularly once the policy's in force. Uh, so,
Mhm.
but yes, like I think the modal, think of it like a $6,000 premium. Even if there's lots of PUA on top of that, 6,000 down to 500 a month, is a lot much, a lot easier to handle, especially if you have like influxes of like a bonus or different structures of cash flow that can allow that to feel a lot less of a burden for that particular month if that's what it would be.
Right. All right. Yeah, guys. So our next example would be using policy loans to pay the premium for that given month or whatever your frequency would be. So what this is once again, we're taking a loan from the insurance company against the cash value that's accumulated in your life insurance policy. And we were going to use that now to pay for that upcoming premium payment. Why is this a good strategy, and why suggest this to begin with?
I think it's a great strategy because, like, in my first example, let's say, I'll use John's. So let's say 6,000 was your annual premium on the base portion, and you had some other pay up additions that you might do out to, throughout the rest of the year. But let's say you had 4,000, and your annual payment was coming up, and you're like, oh, I'm 2,000 short. It really is like it frees your mind. Like we're kind of constrained with our thinking of whole life. Just get a policy loan for $2,000, and then you can do your annual payment. It's that simple. And once I realized that, that was like another wow. That just like took all the pressure off, because I can just call them up or do it on my phone and say, send me $2,000 and then get a check, and you deposit into your bank account, and now you pay your lump sum, your premium of 6,000. I don't have to change my modality, and then I know I'm coming up with that 2,000 soon, let's say, or whatever. You just have that flexibility. That's just a super easy way to cover you in that spot. Insurance company doesn't care. Like, they just don't care. And so that's just a really quick and easy first step to cover that if you have any kind of gap in a premium payment for that year or that month or whatever.
Yeah, because you get tons of benefits for doing that. One, you're not interrupting the growth of any of those dollars, right? Uh, Two, you're giving yourself the freedom to repay yourself, right? I think that certainty of knowing, like, oh, what if I had to pay this with a credit card, or would I have to pay this with a HELOC or whatever it may be? Like you're now subjecting like that obligation to the bank or to the credit card or whatever it may be.
Mm-hmm.
But if you're the banker and you control that policy loan, you just have like you can take a deep breath. You could just take a couple months and just regroup if that's what it needs. And maybe it's an employment gap or whatever it may be. That's okay. And like you said, Rob, like the life insurance company won't come knocking on your door. They don't really care. They just want to protect you and keep that policy in force. So I really prefer this option, truthfully, amongst all the others, because it keeps things rolling and it gives you time to catch up, per se, if that's what you need in that particular life scenario, without interrupting any of the benefits that you otherwise would be getting. So that's really powerful.
Yeah, I think the thing to note or to remember about with any policy loans is there is interest that's accruing. And so the important thing is just to have a plan in place of how are you going to pay back that policy loan. And hopefully it's within that year at the bare minimum. Rather than, I mean, I don't think we would want to necessarily recommend or suggest taking out another policy loan the following year to pay that month's premium, because then obviously we haven't done our homework. We didn't set you up well in that scenario there to where, are you really being stretched now too much?
Mm-hmm.
And we've got other solutions that could help maybe to alleviate that. So the next example would be using the dividends, or what's oftentimes referred to as premium offset. So just another example here. What the dividends are is the surplus profit of the mutual insurance company, which you are a part owner of if you're a policyholder. And generally, the way that we maximize these policies is to allow those dividends to continue to compound and purchase more life insurance inside the policy. That's the ideal. Now, in this scenario here, it's obviously something has happened to cause us to say, okay, maybe we need to look at something less than ideal. And so you could use that dividend amount for that year to help pay a portion or maybe even all of the required annual premium. Guys, what's your thoughts on this example here? Um, you know, when do you suggest it? When might you not suggest it?
Yeah, that's just another good option, another piece of the flexibility that you get with a policy, with a insurance policy like that we design. You have that flexibility of you can do premium offset. You can allow you. Let's say you didn't. If you, I don't, if you didn't want to take a policy loan or you couldn't take a policy loan, and you are having dividends that are meaningful, you can elect to have those dividends pay for your premium or a portion of your premium to help you out there. So that's just another option, another tool in the toolbox that you have in terms of flexibility of your policy and the protections that are built in. I would go policy loans first because once you are using your dividends to pay your premium, then you are not you're kind of breaking the compound growth of your policy at that point, because the dividends, the way we like to set them up, as Derek mentioned, we like to set it up where dividends are buying more death benefit, paid up additions, so that does that compounding for you. But it's just another good option if you just didn't want to take a policy loan or couldn't for some reason. You can use that premium offset or that dividend paid up the dividend option to help pay for your premium. So just another tool in the toolbox.
Yeah, Nelson illustrates this in Becoming Your Own Banker. And
Mhm.
most of his illustrations, once, if they do become at a point where there's no new dollars funding the policy, he elects to have the dividend pay for the premium and so forth. And, in any of these policies, if the dividend meets the required premium, then for the rest of the life of the policy, it will most likely meet or exceed that annual premium, so that even on top of the required premium, you're getting additional PUA
Mhm.
to increase that death benefit and compound, just like you're saying, Rob. But what's interesting to me is in Becoming Your Own Banker, the fifth edition, Nelson states as a little add-on that yes, in these illustrations, I had the dividend, have it as a premium offset, but more advantageous would be for the cash value to fund the premiums for the rest of its life, to not interrupt that. Like, respecting the growth for the rest of the life of that policy is huge, and letting that one
Mhm.
dividend maybe 20 years ago, like that has the implications 20 years down the road, 30 years down the road of compounding growth that is honestly hard to see for most people. But once you see it, you see how beneficial that ends up being for your family.
Yeah, even just a small portion of offsetting the dividends to pay the required annual premium can have big effects depending on, obviously the age and the overall premium amount, to the tune of maybe even a couple $100,000 in future cash value or future death benefit to your family
Mhm.
members, depending upon your scenario there. So that's a good caution to be thinking about. The last example here's potential solution is what we call the reduced paid up option. John, why don't you go ahead and just explain for our listeners what is a reduced paid up?
Yeah, so the way I like to describe this is starting with what life insurance companies see as expected premiums for the policy, right? For most of them, they're either payments until age 95 or till age 100. So they plan actuarially the death benefit in relation to the premiums to pay for the rest of your life, most likely. And so that's how it's calculated. That's how it's all factored in. So if at any point the contract owner, right, the policy owner has the right and the option to reduce and just pay up the policy, meaning like say you're 20 years into the policy and you're maybe just hitting your passive income years and you just want to not worry about annual premiums. It's a relatively common situation that we'll see it. You could just say, hey, life insurance company, I don't want to actually pay a single penny more in annual premium. I would like this policy to be paid up. And then the reduced part is your death benefit. right? Because you're not paying any new premium for the rest of the life of the policy, however long that may be, whatever those premiums essentially purchase in future time is what is going to be reduced in the form of your current death benefit, right? So uh, the trade-off, just like we say fairly often, is that there's no deals in life insurance. There's a trade-off, right? You get the benefit of, and I wouldn't even call it a benefit, honestly, because you're still having to deal with banking and money in one sense or another. And what better place to store it than your policy? So I think in any
Mhm.
case, you would want to pay more premiums. But if the situation arises, you want to do an RPU, reduce paid up, the benefit is you don't pay any more premiums, but the offset or trade-off is your death benefit is going to reduce by the amount of those future premiums and what death benefit that would purchase. So, if you already have a season policy and maybe the dividend is exceeding the annual premium, it doesn't make sense, honestly, to me, why someone would want to do that. But if anyone ever wants to elect to do that, you definitely can. You're the contract owner. There's nothing saying that you can't, and that's definitely an option, especially in the later years when maybe you just don't want to even think about it, right? You're maybe thinking, okay, I'm going to be 95 years old. I honestly just don't want to, think about this or care about a new premium introduced into my life. So that's how I normally describe it, and that's generally been a helpful way to think about it.
Yeah, that can be a good strategy. I look at it like I often model it in the I'll call it the passive income years. Let's say you want to start taking income from your policy. That could potentially be a time when you just don't want to be paying into it anymore. The good thing is just have that freedom. Just it's a very simple process to just pay up your policy, and you're done paying premiums on the policy. It'll continue to grow. The dividends will still the death benefit will still continue to grow. The dividends will still be getting rolled back into the policy, buying more death benefits. So even if you do reduce paid up in the later years, you still have the benefit of growth, which is another amazing property of these properly designed whole life policies. And also, if you happen to have any policy loans out at the time, that gets factored into the reduced paid up. So then the policy loans then are deducted from the death benefit. So then if you had any loans, those get taken care of. So it's just kind of a nice way for some, if it makes sense at the later years, you just want to wrap it all up, button it up, and then still have a policy that's growing and still have death benefit cash value you can leverage. It's a very viable option in the later years.
Yeah, and I think at least in my lifetime, I've seen where this could maybe be be something that somebody could take advantage of a couple of times. My brain thinks back to the financial crisis in 2008, where national home builders are no longer building homes. So if you're a carpenter, probably had a hard time finding work for a year, maybe two, or if not longer. And so that can be difficult to figure out, how am I going to pay premium? Maybe the reduced paid up would have been the best option then. Or another example could have been if you were in the airline industry during COVID-19, right, where you weren't flying for a year and a half or 2 years. If you've exercised all these other options that we've talked about, changing your premium frequency to monthly payments, using the policy loans, maybe using the dividends, and then the last ditch, solution would be the reduced paid up. But we go through those cycles, we go through recessions, and it hits many different industries, and you never really know what's going to happen to you. And so those would be kind of the case examples of, was that a good solution back then? And I think it certainly could have been part of the solution. But once again, it's always kind of our last ditch effort of, we want to try to avoid doing the reduced paid up as much as possible, if you're still in your working years. Guys, any other thoughts or examples that come to mind of when to utilize any of these different solutions and strategies that we've talked about?
I
I
would
would
just add that
just go ahead, John.
I would just add that it's maybe unseen or underestimated the value of doing this like in community and in relationship. And what we just love about what we do is that we build these lifelong, like trusted relationships where there's no fees about calling us. There's no issues to like, we love doing this and we love walking through maybe crunches in cash flow or tight situations and just helping people process through what that step would look like, right? Because maybe you had all the education in the front end and you feel good about the flexibility of these policies, but honestly, like when the rubber hits the road and things get tough, you want to know that you have someone you can lean on, and that's what I just love about what we do, and that we can be that, just resource and just extension of your financial picture to be able to help you see just what options are before you. And even in advance, if you think that maybe cash flow is going to be tight upcoming and I want to get my spending in control or whatever it may be, we have tools and resources to help you with your cash flow, even to get that under wraps. So
Mhm.
we love that we are like more than just life insurance agents. We are actual advocates for you to succeed. And infinite
Mhm.
banking is, we believe, one of the best ways to do that. But on top of that, there are other resources, and just on top of building a relationship with us, where we can advocate for you in those tight situations if they ever come, because we know life happens.
Well said.
Right, guys. Well, once again, Merry Christmas to you and to our listeners. In our next episodes coming up, we've still got more exciting content. We'll be continuing not only in the mechanics of life insurance, but we'll also be talking about our faith and finance series in episodes coming up here as we look toward the new year and some exciting goals and challenges for 2025. If you are a listener and are interested in learning more about how to start your own family banking system, you can certainly reach out to us at thefamilybankingshow@gmail.com, and we would be happy to sit down and schedule time to meet with you and your family and to discuss what some of your options are. Once again, Merry Christmas and a Happy New Year to you guys.
Merry Christmas, everybody. Merry Christmas,
Merry
guys.
Christmas.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.